The hardest part for most people when it comes to a renovation is paying for it. But did you know there's several loan options if you want to borrow money to renovate your current house? There's also several options if you want to buy a fixer-upper. In this video, we'll go over those options so you can decide what's best for you. First, let's start with buying a fixer-upper. At the time of filming this, we're coming out of what hopefully is the tail end of the pandemic. The federal foreclosure and eviction moratorium has been lifted. Now, because of that, we're starting to see some more distressed property hit the market. Buying a fixer-upper can be a great way to build wealth. The general concept is to buy something and make renovations that increase the value of the home. After renovations, ideally you'll have a good amount of equity. Equity is the difference between what you owe on the property and what it's worth. So let's say you owe $200,000 on a property and it's worth $300,000. You have $100,000 worth of equity in that situation. With a renovation loan, you can buy the property and finance all or some of the renovations you want to make. And there are actually several renovation purchase loan options. One of the most common renovation loans is an FHA 203K, which allows you to finance the purchase plus the renovation costs while only putting 3.5% down. And there are two different versions of an FHA 203K, what's called a limited 203K and a standard 203K. The main difference between a limited and a standard 203K is you cannot finance more than $35,000 worth of repair with a limited 203K. Also, the repairs you're financing cannot be structural in nature. So let's say you need a new foundation. A limited 203K is not the product for you. But with a standard 203K, it's possible to finance over $35,000 worth in repairs. There's a little more red tape with a standard 203K, so just be prepared for that. Now, the next option is a conventional product called home style renovation loan. The good thing about this loan type is you have a lot of leeway. You can finance things like flooring, cabinets, appliances, trim, bathroom renovations. You can even use this product to install a well or a septic system or a pool or garage. And unlike other renovation loans, it doesn't have to be your primary residence. The last renovation loan type I'll touch on is a VA renovation loan. What's awesome about this product is it's up to 100% financing. Now, this is for folks who have VA eligibility. So if you have served or are serving the military, chances are you can apply for a VA loan. Just like the FHA 203K loan, this renovation loan is only for primary residences. Now, generally, repairs have to be non-structural in nature, and the maximum renovation amount must not exceed $50,000. But let's say you already own a property. A lot of people don't realize that you can actually use a renovation loan to refinance your house. So let's say you've got a house that has some issues that would show up on an appraisal. These products would allow you to close on a refinance as long as you're addressing the issues that come up on the appraisal. But what if your home is in good shape but just needs some updates? Look into doing what's called a cash out refinance. In a cash out refinance, you're borrowing against the equity of your home. With home prices going up and inventory being extremely limited, I think we'll start seeing a lot more cash out refinances. A lot of current homeowners are unwilling to list their house because they're unable to find another house to live in. So in turn, people are now turning to renovation loans and cash out refinances to renovate their property. With a cash out refi, you can even use those funds for all kinds of things, including debt consolidation, home improvement, or making big purchases. If your home is already in good shape, you may be better off doing a cash out refinance. The main difference between a cash out refinance and a renovation loan, you're borrowing against the current value with a cash out. With a renovation loan, you're borrowing against the projected future value after the repairs are made. For a VA cash out, your max loan to value is 100% of the appraised value. With FHA, you can borrow up to 80% of the home's value. Here are the max LTVs for a conventional loan. For a single unit primary residence, your max LTV is 80% of the current appraised value. If it's your second home or an investment property, the max LTV is 75%. For a duplex, if it's your primary, the max LTV is 75%, but if it's strictly an investment property, your max loan to value is 70%. Let's say you own a triplex or a quad. The max LTV is 75% if you live in one of the units and 70% if all units are rentals. It's also important to note that you cannot have a multi-unit property that is technically your second home. The last option for financing a renovation is what's called a home equity line of credit or a home equity loan. If you're considering one of these products, start at a local bank or credit union in your area. Think of a home equity line of credit or a HELOC as a big credit card that's attached to your house. The good thing about HELOCs is you can use those funds and pay them off multiple times. It's revolving. Personally, I have one on my house, but I've only used it once, and that was right after a hurricane came through and I financed some repairs while I waited for my insurance money to hit. With HELOCs, you have what's called a draw period. You can pull money off of the line of credit and make either minimum payments, or you can start paying it back in big chunks or in full. After your draw period ends, which is usually after the 10th year, it then turns into a loan and you'll start making payments based on the remaining balance. With a home equity loan, you get a set amount and the repayment starts immediately. Unlike a HELOC, you will only get one payout. This product can be better if you know exactly how much you need and you know it's only going to be a one-time thing. The last product I'll briefly touch on is what's called a hard money loan. These loan products are harder to find and the rates and fees are pretty high. Think of these loans as like a big payday loan. A hard money loan is best served for someone trying to flip a home for a quick profit, whereas a renovation loan or a cash out refinance are better served for someone wanting to own the property for a longer period of time. Now, before you start going and renovating your property, keep in mind not all renovations are created equal. Some renovations don't have as much of a return on investment. I'll do a video soon on what renovations are the best investment. If you found this video helpful, do me a favor and hit the like button so more people can see it. If you're new here, my name is Nate. I've been a licensed loan officer for about 10 years. I make a lot of content about mortgages, real estate, credit. If you're interested in learning about that, consider subscribing.